Hi, I want to talk to you today about my friends at Bitwise and why they're the best crypto asset manager out there. So many investors I know are working with Bitwise today. They've got more than 20 products to help investors get whatever access they need or want. They've got a team of more than 100 across the US and Europe. They have more than $10 billion in client assets. It's not just the products that show they're all in. They've even supported the ecosystem by donating 10% of their Bitcoin and Ethereum ETF profits to open source developers. And they were the first company to publish their Bitcoin ETF wallet address. Like I said, these guys are true OGs. So please go and check out Bitwise. They really are excellent. Go to bitwiseinvestments.com and see all they've got to offer. That's bitwiseinvestments.com, or just email them at james@bitwiseinvestments.com and let them know that Raoul sent you. Anyway, there are a million ways to access crypto. Explore how you can access it best with Bitwise. And remember, carefully consider the extreme risks associated with crypto before investing. Anyway, thanks very much.
Yalla Habibi!
It's good to be here at the main blockchain event of this year.
You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. So we get all of that, all in one place. See you at Token 2049 in Dubai.
Hi, I'm Raoul Pal, and welcome to my show, The Journeyman, where I travel to that nexus of macro crypto and the exponential age of technology. One of the big themes in crypto that gets talked about endlessly, particularly now with the regulatory changes, is the tokenization of real-world assets. A lot of people don't really know what that means. But, I've been at the center of the financial system for 35 years now, and there's many things that most people don't understand how they work and what they are in the finance system that are likely to get tokenized. Now, there's one pioneer in this space that's light years ahead of anybody else, and that's Mike Cagney. Mike Figure knows what is going on because he has been the pioneer of this space. And I want to sit down with him to find out what's really going on with the tokenization of real-world assets, how he thinks it all fits together, and how it plays out, particularly now that we've seen a huge sea change in the US government and its approach to regulation. Where are all of the big players in this, and what are they going to do? Anyway, this is a really important conversation, so I hope you enjoy it. Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Mike Cagney, welcome to Real Vision.
Thank you. Thanks for having me.
Yeah, we were just saying beforehand, I'm surprised you've not been on before, but I think it's going to be a really interesting conversation because what you're doing is, I think, very interesting to the future of this space and what it means. But before we go into all of that, let's get your story. How the hell did you get into this in the first place? Because I love the stories of how we all stumbled into this. And you're a finance guy like me, so I don't know how the hell you managed to do that.
Yeah, no. So I started in the late 90s in financial services. I ran structured product development and prop trading for Wells Fargo and had a keen appreciation for capital markets. But this was in the late 90s, and we entered the dot-com boom. And at one point, I remember my boss came over and said, anyone with half a brain would be out doing a startup. And I said, well, I have half a brain. So I started a company in wealth management technology that I sold to Brokerage in 2006. And then I started a hedge fund, kind of going back into the prop trading side of things. And as I was...
What was the hedge fund doing? What strategy?
Full macro.
Oh, so same as my background. I was a Goldman, and then I was running global macro hedge funds, all of that.
That's right. And Goldman was one of my primes. As I was building that business out, I was watching what Chris Larson was doing in this company, Prosper. So Chris had been originally at eLoan, I think, and I'd met him there. And then Chris had gone into Prosper, which was the first peer-to-peer lender. And the whole concept of disintermediating financial intermediaries, of connecting sources and uses of capital, was super fascinating to me. So I was really excited about what he was doing. And and the crisis happened, and fortunately we were on the right side of the crisis, but it was very stressful process. And so in 2010, I'd been staring at my Bloomberg screen, watching it blink at me, and I said, I really want to go back and start another company. And I had an opportunity to go to Stanford and do a fellowship at the Graduate School of Business there for a year. And when I was there, I met my co-founders at SoFi, and we started the student loan refinancing business. It became a much larger financial enterprise. And I remember I reached out to Chris and I said, hey, I have this idea about refinancing student loans. And he's like, that's a horrible idea. It's never going to work. It's crap. Don't do it. So I did it anyway, and it worked out pretty well. But what happened was Bitcoin was becoming more visible. And
what year was this?
This was 11 when we started, and around 13, 14, there was a lot of discussion around Bitcoin. I think in 15, I did a panel down with Larry Summers and Brian Armstrong, and Brian gave us all one Bitcoin, which I subsequently lost, by the way. At the time, it wasn't worth what it's worth right now. But I'd given Bitcoin lip service, but I didn't really know what it was, and I didn't really know what blockchain was.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
And so when I left SoFi, I spent some time thinking about what I wanted to build next. And that's where I had my aha moment with blockchain, where I said, if you could actually displace trust with truth, you could do a massive transformation of the way that capital markets work. Because today, capital markets are significantly intermediated because you don't have truth. In stocks, there's 7 parties that sit between a buyer and seller. Debit card, there's 5 parties that sit in between a buyer and a seller. And so if blockchain can distill that down to a bilateral transaction, you can disintermediate trillions of dollars of market capitalization. And that to me was what was interesting. And that's where I said, okay, this is actually really cool technology. We should figure out how to do something with it.
Yeah, because it was 2012 for me, because I kind of predicted the financial crisis did well from it and the European sovereign crisis. And it was the European sovereign crisis that taught me about collateral crisis and that nobody knows who owned what collateral.
Right.
Do you know Emil Woods and Chad Cascarilla?
Yes.
So it was those guys who were Global Macro Investor subscribers who said, maybe Bitcoin's the answer here. And I wrote the first ever macro strategy piece on it back in 2013. And the idea was all of this, all equities, all the custody, all the bonds, all the credit, OTC derivatives, the whole lot should go on chain because there's a source of truth that is fundamentally required in the event of something going wrong.
Well, the source of truth is incredibly powerful. And, I remember sitting down with Sheila Bair when we started doing what we were doing. And she said, geez, if I had this during the crisis, it wouldn't have prevented the crisis, but I would have known where all the bodies were. And especially all the ABS workout deals where you couldn't identify the bondholders, you couldn't modify the collateral. And so you made things much worse. This is a clear solution to it. But I think what it really gets to and what the real power is having a native digital asset where I can get true perfection. I can do a UCC Section 8 perfection on it, for example. Having that ability allows you to lend to that asset irrespective of the counterparty itself. So you're not underwriting the counterparty, you're underwriting directly to the asset. I always use the analogy on this that, I've done billions and billions of dollars of HELOCs and mortgages, and generally they perform really well, but some I've lost money on where, I mispriced the collateral, I've not been able to foreclose or what have you. I've been lending against Bitcoin since 2020. I've never lost a dime because I have 24/7, 365 collateral perfection. And so bringing that concept in allows us to start thinking about displacing the way capital is distributed today through prime brokerage, like Goldman Prime, Morgan Prime, et cetera, and into a more democratized construct where anyone with money can lend to anyone who needs money on a security perfected basis, right? Where they actually have true perfection of the collateral. And that's where I think you get to real disruption. So, on a first order, there's blockchain efficiency. So at Figure, and we can go into this in some depth, but we've been able to extract over 100 basis points of expense reduction through blockchain and in securitization and the origination, warehousing, aggregation, and securitization of assets. That's the first order, and that's valuable. There's the second order effect, which is if all this is on chain, it opens up cross-collateralization in a way we haven't been able to do historically, and that unlocks the ability to deploy more capital, but that capital has to come from somewhere. And the $2.5 trillion prime brokerage ecosystem is kind of tapped at this point in terms of its size, scope. And so if we can then upend that, not so much just disrupting it, but massively expanding who has access to that capital through this whole democratized construct, that's where, we're really changing capital markets. And that's what I think ultimately happens with blockchain. I think it will ultimately yield to a massive shift in how capital markets work.
And I think what's interesting is what you're talking about prime broking is banks' balance sheets are restricted because of Basel III and soon Basel IV. Their ability to lend or leverage their balance sheets in the way that's required to expand that has been one of the things that has restricted the hedge fund industry as well, because there's just not much available. But you went through something that I was involved in also in around early 2012, 13, 14, was this direct lending model. And that was the first glimpse. Family offices were lending directly to trade finance and stuff like that and getting great rates of returns. And there was no intermediary in the middle. And I think what you're saying is we can do that all over again to the massive prime broking industry, both in traditional markets and in crypto markets, because the hedge fund industry is nascent but growing.
That's right. It's what I call democratized prime brokerage, and I think that is a reality that we're going to see over the next couple of years.
And so, talk to me about the journey of Figure, because you start off with the securitization, but you're building all sorts of things. So, give me the whole Figure story.
Yeah. So the initial story was predicated on that disruptive concept of taking out 100 plus basis points of cost through asset origination, aggregation, securitization. And by the way,
just to explain to people why 100 basis points is a big deal.
Yeah. So you're in an industry where your gross margin might be between 300 to 500 basis points. So, and that's gross. Your net would be, 1 to 200. So taking 100 basis points of cost out is a massive profit enhancer for you. And by the way, when I started Figure, I reached out to Chris again and told him I had this idea about using blockchain to disrupt the capital markets. And he again told me it was a dumb idea and I shouldn't do it. And it would never amount to anything. And so, I've now listened to him twice. Both times it's been the right thing to do, but I have great respect for him. And so, by the way, Chris pioneered peer-to-peer lending. Like, the Lending Club folks generally get the credit for that, but it was Chris Larson doing all the hard work in the very beginning. And I have a lot of respect for him for doing that. But so the basic premise for us was we wanted to build this disruptive capital ecosystem, and we kind of had to work backwards to, I went to a bunch of banks in 2018 and I tried to convince them, look, if you do asset origination and securitization this way, here's why you're going to save money. Here's how blockchain is going to be effective. And they all said, this is great, Mike. We love it. We'd like to be the 10th bank to do this on blockchain. And so, obviously we had to have a first mover. And as an entrepreneur, you're always trying to de-risk that first mover. And so I said, well, we'll just do it ourselves. I'll just stand up a lender and I'll start lending on chain. And so we did the first loans on chain in 18, did the first securitization of blockchain loans in 20, did the first AAA rated securitizations of blockchain loans in 23. And at this point, we've done, I think, somewhere between 42 and 43 billion of transactions on public chain and lending.
Who's involved in that ecosystem now? How is that working? Because people kind of don't realize that there is parts of the financial system that is using blockchain and has been for a while. So talk through that, because I think it's interesting.
Yeah. So one of the big challenges is, we interact with lots of the big sell side firms, obviously lots of the big buy side firms like Apollo. Goldman will be talking about how they're using our blockchain registry for all the mortgage transactions we do with them. No one's been allowed to discuss this over the last 4 years. So the regulators have basically said, you cannot discuss being on public blockchain. and that's forced us to be a little bit not as vocal as we'd like to be in terms of the size and scope of what's happening. But it's actually the broader TradFi ecosystem, especially on the mortgage side and on the lending side, is moving into it and realizing there's significant dollars that they're capturing by being in the space. And that's, at the end of the day, that's what you need. You need an economic reason why to be on the blockchain. In 2018, you could do blockchain projects for the sake of blockchain, and there are all these goofy things that were done where you'd replicate a ledger on chain and stuff that didn't really matter. And I wanted to do real stuff. I wanted to create assets that only lived on blockchain, that you had true perfection, and that we could demonstrate this capital efficiency. And so we've been able to do that. We've been able to crowd in a lot of large traditional players. And one of the big things that we're talking about this week, and I think if we're airing on Thursday, this news will be out on Thursday. We're standing up a permanent capital guarantor that functions like Fannie or Freddie functions, to create a liquidity market analogous to a GSE market with that kind of predictability and liquidity, but all native on chain for private credit. And so, if you look at what we do today, the challenge you've had with loan origination historically is, people do HELOCs or non-QM mortgages or prime jumbo. They do them as a one-off asset pool with a one-off loan purchase agreement. Because they're one-off, they have no homogeneity or liquidity. They just sit and exist. And what we were able to do is we were able to create a homogeneous asset origination process. We now have over 140 third parties that use our tech to originate loans on chain, right? Some of the largest mortgage originators, banks, other factors. To them, it's technology, right? They don't see it as a blockchain transaction per se. It's a technology transaction. We have over 140 third parties putting those assets on chain. Those assets are all completely homogeneous, and the blockchain takes a lot of the uncertainty of the asset out in terms of the ability for someone to modify data or change something that they shouldn't be able to change. And what that's allowed us to do is we now run regular bid wanted, order wanted, and competition markets for whole loan pools that trade and instantly settle, unlike what we've done historically, which is 7, 14, 21 days of diligence. There's no point in having a digital marketplace for credit historically, because even if you transacted, you'd have to go and spend 3 weeks to do the diligence to clear. Our stuff, because of the blockchain and because of the homogeneity, trades like a true digital asset, like an equity would trade on a typical national securities exchange.
Have hedge funds come into the space because there is now liquidity, transparency, and ease? Have they gone up? Because we need multi-parties to create liquidity in a market to make it a real market. Because if not, it's kind of interesting to watch, but it gets stuck at one counterparty and it doesn't get circulated.
Right, and the hedge funds have been very involved. And one of the most interesting things, the most interesting hedge fund use case I saw was, because of the way we use blockchain, we have real-time remit on all the loans that we do. And so I can go on and see, it's 11/20 in California right now. I can see every loan that's paid me as of 11/20. And so in March of 2020, when COVID hit and they introduced the moratorium on mortgage payments, everything that wasn't an agency mortgage became completely illiquid because nobody knew how it was actually cash flowing. The hedge funds ended up, got a dog here. The hedge funds ended up buying our paper specifically to get the real-time remit reporting, because they could front run the agency remit reporting that would come out 30 days later. And so they were using it to front run the information flow because they had better information from the blockchain.
Super fascinating. So who else is in that space, and is it starting to grow outside of what you guys do? Because you guys have done the hard work. I mean, I cannot imagine that this was easy to do. Dealing with banks and institutions and getting them to change technology away from what they did is preposterously hard.
Well, and dealing with the regulatory environment we've had for the last 4 years has not been an easy thing either. So it's been a challenge. Like, I think right now in the land of RWA, we stand very unique in that, we're adding 500, 600, 700 million a month RWA onto Provenance blockchain, onto the L1 that we use. I think that's only going to accelerate with this guarantor that's being stood up. We're expanding into other asset classes. I think we'll certainly see more people coming in to participate, whether they participate by creating rival ecosystems, whether they leverage our ecosystem, because there's aspects of Figure's ecosystem that's valuable. One of those is we have an alternative trading system exemption to actually trade blockchain native securities in bearer form. So we can trade securities that self-settle, self-clear, and so effectively creating digital security or digital native blockchain ABS. Plus, we have the capital in there. Plus, we have a broker dealer and a bunch of other things that help facilitate that ecosystem. But one of the things that I think is really interesting, and one of the areas that I've had a lot of concern about, a little less concern over the last couple of months, has been fiat and how you express fiat on chain. And back in 23, I was working with a group of banks to try to digitize deposits on chain and effectively create a reciprocal payment network. So a better version of ACH where they could do that on chain with the efficiency and certainty. And the regulators stopped it. They came in and said, we don't want you doing this on public blockchain. The Fed had come out with that statement. The public blockchain wasn't consistent with safety and soundness, which was a ridiculous statement to make, and really just impeded a lot of the development that could have happened at that time. But it got me to step back and say, okay, these regulators don't want public blockchain, and there's very clear how they can do that. They can choke off the dollar flows. And we started seeing the banks that provide those dollar ramps go away. Either they went away through the fact that the FDIC took them over, or they went away because they were forced out of the business. And then, we had United Texas Bank Dallas that provided all this correspondence service for the foreign banks, for Frick and Signum and others. And they got a cease and desist letter from the Fed, right, saying you need to get out of the blockchain space or the crypto space. And so I was trying to future-proof that. And so I was looking for a way to create a security, a public security that could live on chain, that would provide a fiat rail, way to get money on and off, not through a banking channel, but through a security channel, where it's not crypto, it's a security, it's just on public blockchain, because there's no limitation that security can't be on public chain. And obviously, Franklin and WisdomTree had tried to do this with their money funds, with Benji and the WisdomTree product. And the problem the money funds have is they have to trade in a regulated venue. You got to trade them on an ETS, or you got to trade them on a national market exchange, and that doesn't make it practical if I want to give you $20, for example, right? We're not going to go through that premise to do it. And so we ended up researching this really esoteric security called a face amount certificate, and it was written into law in the 40 Act. And a face amount certificate, nobody uses these things. Like they're very odd securities, but they're the only security that allows you to move peer-to-peer without a regulated framework. So I can take $20 of a face amount certificate and I can move it right to your wallet, right? And that's a legitimate transaction. And so we did our first S1. This is public record. You can go on Edgar and see it in August of 23. We'd done confidential S1s before that. And what we've been able to do, and this is super interesting, but we're essentially going effective on that security today. And so we have a public fixed income security native to blockchain, pays SOFR minus 50, freely transferable peer-to-peer, that can be purchased at an aggregator and effectively turned into a GDR onto other chains. So it can work on Solana, it can work on Ethereum, work on other places as well. That we think is a foundation. It's effectively the ability to move value in a way that doesn't take some of the credit risk or the certainty risk that you have with traditional stablecoins. And so, we're excited about that opportunity, and we think all these things kind of build into an ecosystem that we hope attracts a lot of asset origination, a lot of capital.
Because if you go back to the prime broking part, all of this is all fits together as well. It's that kind of whole basket of asset requirements that more sophisticated players need. But in this new form of money that you're moving around, are you expecting it to be retail, or are you expecting it to still stay within professional markets but be fast, efficient way of doing things?
I think it's going to be both. One of the things that always strikes me is I got a chance to look at the Coinstar business at one point. And the Coinstar, they have those kiosks in the grocery stores, and you put your coins in them, and they give you a gift card.
Oh yeah.
Well, the number one thing those are used for is people buying Bitcoin and sending it to somebody. And so they're effectively Bitcoin kiosks more than they are anything else. And I was looking at how people were using that for cross-border remit. And I was like, this is just illustrative of how inefficient, how much friction there is to move money cross-border. So you get something like yields, which is what our securities call YLDS. And the Edgar filing, it's figure certificate company, if folks want to go look at it at the S1. But effectively, you now have essentially dollar bearer cash on chain. So it has massive application for cross-border remit. I mean, in order of ease to complexity, obviously collateral on the exchange is an easy use case because it yields. Exactly. And so there's a lot of value there. And we would expect, partners of ours like Jump Crypto and others would be using that heavily from a collateral standpoint. There's cross-border remit applications. There's payment applications. In the US, it's hard to disrupt the payment ecosystem because you have this five-party interchange, but the first thing you can disrupt is the rail. And so dropping this in as the rail in lieu of ACH is a pretty interesting application. But outside of the US, where it's QR code driven, there's a lot of ability to just go straight bilateral peer-to-peer payment. So we think it's what the industry's needed, and the challenge that we've had historically is USDC is crypto, and the banks haven't been able to hold that. This is a security; the banks can hold that. So, barring any change in regulation and so forth, in terms of the stablecoin legislation that's working through, today banks can use yields because it's a security. It just happens to be on a public blockchain.
And what about off ramps out of that? If people want to exchange it for cash or whatever their needs are, the fungibility within the real world has always been another issue, right? Because of regulation and banking and
right. So it's a security off ramp, on and off ramp, just as if you were investing in a mutual fund directly from the fund issuer. So we have a set of financial entities that provide fiat rails during market hours. And then what we're working on with a couple of our partners are stablecoin rails non-hours. So, on a non-US banking hour, you'd be able to turn yields into USDC to the extent that you wanted to do that. During US banking hours, you can turn it into US dollars and ultimately into euros and other currency as well.
So you've also built an exchange.
Yeah.
Talk about the exchange and why you did that.
So
I'm trying to get together. There's a vision here of something much larger, and you're building component parts, which I can see. So I'm trying to get to, okay, what are these parts and where the hell are you going?
Yeah. So let me talk about that, and then I'll go back to the exchange and how it fits in. What we're ultimately trying to do is build what we would call the exchange of everything, right? The ability to have equity, fixed income, crypto, all under one venue and all seamlessly cross-collateralized. So if you went to a big sovereign like a Temasek, for example, they would tell you that if they could more efficiently cross-collateralize their assets, they would have twice as much capital to deploy. And so the first step of this is let's get everything under one roof where we have true perfection to the assets. We're not tokenizing a DTC security, for example. The security lives on chain, so we know we have the perfection to it and the ability to liquidate it. Let's get a true blockchain native ecosystem of assets, securities, crypto, et cetera, and provide that ability to cross-collateralize. That opens the second problem, which is if you went to a Temasek or a GIC or a big sovereign like that, they'd say, well, if I could deploy a lot more capital, I can't get it because I'm named full on the prime broker or they're named full on me, right? Effectively, that ecosystem's been topped out. And that's where that whole democratized construct of it doesn't matter who the borrower is, it's people with money lending against assets that want money and disintermediating the construct of a borrower and single name credit risk, et cetera. That's when we really create a massively efficient capital ecosystem. And that's what we're trying to build out. And so if you rewind it, our efforts that we've done on lending and that ecosystem that we're building out, again, there's first order benefits of why we did that. We save a lot of money using the blockchain. It's allowed Figure to be a very profitable business, et cetera. But the real goal is that was just the first of a series of assets we're bringing on chain that allow for that cross collateralization. And we're doing the same thing now with crypto. We're doing the same thing with a couple of different efforts on public equity, including why we're involved in this Ionic situation, which was the miner that came out of Celsius, and what our focus has been on running that shareholder activist campaign there, because we want to get that stock listed on chain and start showing this ability to seamlessly cross-collateralize across asset types. And so within the exchange itself, it really forced us to think about how exchanges work. And the thing that I always kind of scratch my head on, it's ironic that Binance and Coinbase are as large as they are, trading blockchain assets, but not in a blockchain, right? It's a true centralized exchange construct, right? You deliver your assets to them, they hold the assets. And the fact that we still do that after FTX is mind-boggling to me. And so my view is that any exchange that's going to really work needs to be done in a true, a self-custody construct. And the challenge on self-custody and the challenge in structuring it this way, as is these L1s aren't cross-compatible, right? Solana doesn't trade on Bitcoin. Bitcoin doesn't trade on Ethereum. And so the exchange is saying, well, I'm doing you a service, taking all this in and allowing you to trade an electronic representation of this, because you don't have to worry about this cross exchange and wrapping and all this other stuff. But the reality is we have a really elegant solution that's come to market over the last 1+ years, multi-party computation wallets. And these MPC wallets allow us to be able to represent Bitcoin on the Bitcoin network and Solana on the Solana network and Provenance, Figure loans on the Provenance network. And it allows us to create a security entitlement against those assets that can trade on an exchange. And it allows us to do a decentralized MPC where the policy agents themselves are distributed, where you make it much harder to hack. You eliminate the whole key loss issue. You eliminate the exchange idiosyncratic risk where they no longer have your assets. They go bankrupt. You don't have to claim back to them to pull your assets back. It's effectively self-custody, but it's a way that can actually work in a qualified custodial construct for institutions and other things as well. And so one of the big focus points of standing the exchange up was building that back-end custodial framework, that MPC wallet structure, where we don't take possession of your assets, right? We run the exchange, you trade security entitlements, but the assets always stay with you. And that's kind of the genesis of why we did that.
So then what's next into this plan? What else are you working on?
Yes.
So you surely you've got to regret having such a big plan at this point. It's a lot of work.
Yeah, it's a lot of work, and I apologize for going through 6 years of work in 20 minutes, but but it's exciting. And look, there's a couple of different efforts that we have going on right now. One is, as I said, we're going to continue to build that lending ecosystem out. We're going to build something that's closer to a Fannie Mae, Freddie Mac construct and go wider on assets there. Two, we're beginning to build the crypto ecosystem out. So we have a U.S. exchange, we have a Cayman exchange, we have an Ireland VASP. We're building geographic representation for the crypto, and we're bringing this democratized prime construct onto the exchange. So when I borrow margin, for example, on the exchange today, it's coming from people who put that capital up, where we run a limit order book to clear the rate for that capital. And so that infrastructure will continue to expand out. But what I'm focused on in a couple of areas I have some keen interest on is getting public securities onto chain beyond the yield stablecoin that I talked about. So we're about to launch our REIT onto the chain, and you'll be able to buy Figures REIT and use as collateral to then buy Bitcoin. And that from a trading standpoint is a good trade because the yield on the REIT's higher than the margin yield on the loan, right? As I mentioned earlier, there's a transaction that we've been working on for a while where, I bid on both FTX and Celsius bankruptcies because I wanted to restart those companies. Because in U.S. bankruptcy, there's a rule called 1145 that lets you issue public equity without an S1. And so you can effectively create a public security without any SEC direct compliant or direct approval to do that. And this to me was a way to get public equity on chain. And obviously FTX didn't restart, which was disappointing. And, we felt that we put a good bid in for that. And it was disappointing that the company didn't lean in to do that. Celsius opted for a different plan than the one that we put forward, but that plan blew up. And the mining company that's come out of that, called Ionic Digital, has not, from my perspective, has not been run very well. And so we're running a proxy battle right now to get 2 board seats in that company. And one of the first things that we want to do is provide liquidity through an ATS listing, and effectively make that one of the first public securities to be trading native on chain. No DTC registration. You're not tokenizing a DTC security. It lives on blockchain. And what my hope is that we can demonstrate with market making, with the ability to borrow, with the right infrastructure there, that there's sufficient crossover from Bitcoin investors to Bitcoin miners that we can drive more liquidity in this environment than you could in a NASDAQ. And then I would have ammunition to go to miners listed on the NASDAQ and say, look, you should be listed over here. And this is kind of the beginning of a concentric circle of how we start getting critical mass of equities on chain. Because I can't go to Goldman and say, good news, your next IPO is going to be on blockchain, because they'd say, why? The NASDAQ works fine. Why would I take the risk and uncertainty to do a blockchain IPO? Like, I'm not going to do it. So I have to demonstrate in a different way that there is liquidity and there is market value in listing this way.
Is there not a market for, we'll call it an ICO, but the IPO equivalent to take many of these private companies public, but digitally native and on-chain? Because, whether it's Dan Tapiera's portfolio or whether it's a bunch of VC portfolios, there's a lot of these that we're kind of not sure what the equity value is because they've got equity in token. There's some way that it feels like a tokenized exchange for equity is a very big thing.
Yeah, and you just have to be pragmatic about a couple of challenges there. One is having enough float and enough liquidity in a single name to keep prices constant and not go stale. But the other is I felt exactly this a couple years ago. And when I first got the alternative trading system, the first thing I did is turned on a secondary for figure stock. And so I ran a 24/7, 365 marketplace for figure equity for 2 weeks, where you went in and it traded and sold, just like you would expect it to in a blockchain. It was real-time bilateral settlement. I encumbered my wallet with money. I faced off against you with the security. Boom, instant bilateral transactions. Everybody loved it. I thought it was awesome. I built effectively a cap table management business called Figure Equity Solutions, and onboarded 600 companies onto that platform to be able to access this secondary market. And I did that just as the market turned south on the bankruptcies. And all of a sudden, nobody wanted to see the price of their equity. And so they're like, we're not going to list anything because we don't want, we want to control the narrative of our equity. And so, there's just some realities you face in the private company land. That is one. And then the ability to have a consistent market.
But I'm more thinking about this. We're talking about public and private. I don't think that distinction needs to happen with the solution that you're offering, right? Which is they're digitally native listed things. So it could be secondary in the case of a private company like Figure, or it could be primary. It's irrelevant because the structure's changed.
That's right. And the premise behind that business was that if we could show sufficient liquidity in private secondary, when those companies went public, we'd say, well, why would you list on the NASDAQ? Right? You have a venue here that's liquid. You have access to capital. People understand your equity. And it makes sense. But it was, just some of the headwinds of trying to do that from private shares proved challenging.
Yeah. Makes sense. And there's just not enough liquidity. It just takes time. How do you deal with the complexity of putting this together? I know I've mentioned it a few times, but look, there's a lot of moving parts. People don't really understand. People wave their hands around and go, oh, real world assets, they're all going to be tokenized. I'm like, you have no fucking idea how complicated this stuff is and how ingrained in old systems everybody is and how big a battle that is. Yeah, it's happening, but it's hard work.
No, look, when we did the first blockchain loan, we went to settle with a large private equity firm, and they said, "Where's the QSIP?" So, well, you don't need a QSIP. We can call it whatever you want. They're like, no, I can't load this into my back office unless there's a QSIP. And I said, well, can I make up a QSIP? It's like, no, we need a real QSIP. So you got to pay $8 or whatever to get a QSIP to put it. I was at a very high profile sovereign regulator talking about getting the equivalent of an ATS system. And they said, well, we need to understand the post-settlement process. And I said, well, there's no post-settlement process. It's bilateral. Like, you face off, we transact instantly, it's done. And they're like, well, we don't know how to do that. And I'm like, well, but that's what blockchain is. There is no moving of anything. Like, we did it when we traded. And so, this, and one last point, I'll belabor this. When I see things like DTC working on blockchain experiments, I'm like, the last thing DTC ever wants in the world is for blockchain to actually work in a marketplace, because there's no role for DTC. And so the biggest challenge we have in affecting change is the entities that normally would be driving that change. It's so self-disruptive to them that they're not going to do it, right? DTC is not going to usher in a blockchain marketplace. ICE is not going to usher in a blockchain exchange. Visa is not going to usher in a blockchain payment rail, right? Because none of these things are consistent with their businesses, because their businesses are categorically rent-seeking businesses that blockchain disrupts out. And so that in itself makes it really hard. And, if you look at how we had to start, I couldn't get a bank to use the technology. I had to create a lending company and a blockchain and go convince the capital markets that these weren't like crazy things that were going to disappear overnight. Like, I had to bring all parts of the ecosystem to the table at once to get it kicked off. And that's why you haven't seen a lot of this happen, because, we were in a unique situation. We had the relationships to do that and the technology prowess to do that. But, generally firms are really good at one of those three things. And so, our unique situation, the team that we have, being able to cut across all three, got us to jumpstart the process. But that's where I think we're going to see a tipping point. And I think the tipping point is going to come from the fact that we've done so much on chain from a transactional standpoint, that the real economics are there, that the sell side and the buy side are there and participating, plus the regulatory change that I expect us to get, over the next 4 years. I mean, look, we did 41 billion or 43 billion, whatever the number is, of real world asset blockchain. And I don't like the real world asset thing either. It annoys me. But
no, I don't. It annoys the hell out of me. It's just assets.
Yeah, I know, but that's what we have to call it. So, $43 billion of that in the hardest regulatory environment we could ever have. What do you think we're going to do over the next 4 years? Right? I mean, it's, it's going to take off. And especially when people can talk about it and not have to hide the fact they're doing it, and point to the value and that we have an administration that's very focused on building and doing more on chain and trying to take the leadership position there. I think, this should be a good run for blockchain.
So if you look ahead into the future a bit, what does the whole blockchain space feel like? Where are we going towards? Because look, it's been a stop-start journey, but it's actually been relatively consistent. It's taken periods of time longer, periods of time faster. Where do you think this is all going?
Yeah, I always view it that under the surface, there's been a steady progress of development. And then on the surface, there's these headlines that we just can't get out of our way and shoot ourselves in the foot, right? We had the ICO debacle, we had the FTX debacle, we just had Libra. Now everyone's back to, blockchain shit. It's just for fraudsters and scammers and blah, blah, blah. Because they're not seeing the real.
We do this to ourselves, clearly.
No, I know. The industry shoots itself in the foot. It can't resist an opportunity to mess up. And, so be it. But there is real work happening underneath that's not as sexy and high profile, but it's meaningful. What I'm most concerned about, or where I tend to be most pragmatic, is the reality that the NASDAQ can process 250,000 transactions a second, right? Visa peak load can process 680,000 transactions a second. The idea that we're at a point technology-wise where a blockchain could displace the market, it doesn't have the processing capacity to do that right now. And so
Getting close now. Fiat, Solana, Sui, there's a bunch of these getting close.
we're getting closer. But we're getting closer to being able to displace one market, right? Like we'll have enough TPS to displace the NASDAQ soon, right? At some point, but that's, not the capital markets. And so, what I think needs to happen is some deep seek equivalent of improvement in TPS, because at the end of the day, you probably don't need lots of public chains. And this is where I vacillate back and forth. Is this a blockchain to win them all, or will there be lots of different disparate chains, and interoperability will matter? But even in the latter circumstance, we're still not at that point of disruption. And so what I think will happen is people are going to double down on the TPS side, native L1 TPS, not L2 or L3. And, and that will pave the way for a meaningful discussion about, hey, let's displace an entire system, right? And so I think, I'm encouraged about what I see now in terms of getting there. And obviously, Solana and Sui have done a really good job, getting towards that, but we still have work to do on that front. So I'm just pragmatic about that right now.
One of my views is that ETH overbuilt capacity, right? Block space, which is fine, because over time, let's say the financial system moves, you get any bank, any hedge fund, any asset manager, they all use Microsoft. Not one uses Apple or Google, right? So there's this weird way the financial system works. It's like, once the decision is made, they do that. It was the same with the IBM mainframes. It's the same in all of this shit. And I have a feeling that it's ETH to lose, because it is battle tested, has the Lindy effect, it has the layer twos. You can spin up a private-ish blockchain, but still public. You've got control over the ecosystem, everything there. So I kind of get the idea that, Solana, could that be used for exchanges or Sui? Yeah, sure, because low latency, high TPS. But for the kind of big stuff that you're doing, it feels difficult not to be on ETH.
Yeah, I think that it's a constant debate that we have, and if you look at why we built Provenance blockchain back in 2018 and then rebuilt it in 2020, it was because at the time what we had was ETH, and Ethereum. It wasn't even that it was slow and expensive; it was the predictability, right? It was certainty of being written, and when I lift an offer, I hit a bid, I expect to be done. I don't expect to hear that my block wasn't written and come back in 15 minutes. And then the proof of stake networks were coming up, or in Solana's case, proof of history. And the challenge we had there was they were functioning like golden data sets, right? So if I put a loan on a network like that, the loan would go to the validators and be written. And I couldn't let my customer PI information or anything else be exposed to a network that I couldn't control. And what we ended up doing with Provenance is build a structure where it acted as a data validation agent, but not a golden data set. So what goes to when I put a 5 gig loan on Provenance, the 5 gigs goes into an encrypted object store. And what goes to the validators is the 256 character hash of that data. And when I trade that loan with you 3 months from now,
So it's sort of like a zero knowledge.
That's right.
Transaction, right?
And when I trade that loan 3 months from now, it will validate that loan is true. If it's not true, it can't tell you what's wrong with it. But that's okay, right? And so, we opted for that to build into that. And at the time, we were overly focused on TPS because, the reality is when you're trading loans and asset-backed securities, you don't need high TPS.
No, they're single transactions of big size.
I mean, we might do 100 transactions a day on that ecosystem right now, right? So it's not high frequency yet. We certainly want to stand up a TBA market, which would be high frequency, and that'll come out of the Guarantor. But so it's if I reference that back to Ethereum, obviously Ethereum going from proof of work to proof of stake was an improvement. I think it is overbuilt. I think it still has a lot of challenges, and I think it's still a hard network for a regulated financial institution to participate in. Now, I think what will be interesting is, my guess is JP Morgan will launch JP Coin on Ethereum before the end of the year. And that would be very interesting if they do that.
JP Coin doing what?
Basically just being another stable. And, but I don't think that could happen ahead of the legislation, the stablecoin legislation. They're trying to get that legislation done ahead of the August recess. So it would be, fourth quarter or something like that would happen. But, it'll be interesting to see where the TradFi leans into Ethereum or not.
I don't know where else they go, to be honest. If you're JP Morgan, right, you're unlikely to go to Solana, or it's because they're more closed ecosystems, right? The monolithic chains versus, the others. It just feels that it's almost impossible to make that decision. They're not going to go to somebody brand new either.
Right.
Not JP Morgan. So it's kind of like it's ETH shit or bust. That's why when I think this thing through, I'm like, I don't see any other solution that's possible at this stage.
Yeah, well, that and that's what the next 12 months will show us, is how these platforms evolve. I think, the challenge Solana has is, the situation that we have with Libra and the meme coin thing, that those are things that don't induce TradFi to come and play in your ecosystem. And they're not bad things. I mean, they generate huge amounts of fees for the network, and I don't begrudge them that at all. But that's not, that's not going to get JP Morgan or Goldman excited to start trading on your platform. So,
although if they can spin the story differently, I mean, look, it's been an ugly shit show, and it's been a bit too grifty. But crypto's been grifty for a long time, right? But at the extreme, because it's a Wild West and it is experimentation. So I get that, and I don't really have a massive issue with it. But the Trump coin to me was really interesting because it shows how fast capital formation can happen amongst a large group of a decentralized entity amongst a large group of people who have a commonality of idea. We saw the Constitution DAO before that was another way. It was another holy shit moment for capital formation. So there was a very big signal. I mean, memes and stuff have a lot of signal about a bunch of stuff, attention, economy and stuff. But for capital formation, I think it was a big moment.
Yeah, it was. It also illustrated the problem we have with fiat rails, right? Because they just couldn't get the money in to support the bid. And this is where, I talk to people and they talk about Aave or Compound. They're like, okay, there's $3 billion of USDC on Aave being lent. And I say, in the securitization market, that's insignificant, right? I mean, you need hundreds of billions, if not trillions of dollars. And so, but the fiat rails have been so sticky to do that. So I think the potential for capital formation is there. But right now, what gated an even faster acceleration of that Trump coin was the inability to get dollars on.
Probably save people a shit ton of money as well.
It did. And, so some people, instead of yelling at their fiat rail onboarding partners, should be, thanking them. But it demonstrated some of the weaknesses in the ecosystem if we want to scale this to prime time.
Exactly. So, Mike, what's next for you guys? Or what's next for you?
Look, I mean, we would like, Figure to be public this year. I think we've publicly said that we had a confidential S1 with the SEC last year. We pulled that because we just could not get a process in place where we could use the word blockchain effectively. I think we'd like to re-engage and push that this year and continue to grow. And I think on the market side, continuing to add product, being able to move into public equity and really beginning this democratized prime, which I would say is a competitor to an Aave or a Compound DeFi construct, but in a more way that you have control through a limit order book of the rates that you lend at, the ability to either fully deploy or not deploy your capital, some other things that I think are enhancements to the DeFi protocols.
And IPO, that's a long process again, right? And we don't really have the clarity then to let people get to market because there's you guys, there's maybe Kraken, there's Circle, there's a whole bunch of people kind of queuing up, but it's been painful.
Yeah, look, I mean, the process last year, I ended up having to split Figure into two companies, Figure and Figure Markets, because what was in Figure Markets was, absolutely a non-starter from an IPO standpoint as it related to the regulators. And what I'm most likely doing now is recombining that company and taking that combined business out, because everything that was a headwind last year, the regulatory headwind, the public market headwind, is now becoming not a tailwind yet, but at least not a headwind anymore this year, right? So we're hearing grumblings. There's going to be support and push for IPOs, blockchain companies, but we haven't seen that tangibly yet. But I don't think we're getting the same pushback, especially in terms of iteration of the SEC. And you can't use this word, you can't say public chain, et cetera. I think that's going away. And I think the public markets there, I've had a lot of reverse inquiry from public market investors who are like, look, I want to invest in Web3 companies. You don't have a lot of options in the public market right now to invest in a Web3 company. I would argue outside of Base, Coinbase is a Web2 company. It's analogous to like a Robinhood. MicroStrategy buys Bitcoin, but that's not an operating business on Web3, right? There's just not a lot of blockchain opportunities for people to deploy capital to, and I think that there's a lot of money out there that wants to deploy to it. So, when there's money that wants to go somewhere and there's businesses that need to take it, a way will be found.
Final question for you: when are we going to get some more depth of understanding of what the new administration is going to do? Because I guess that David Sachs is probably speaking to Mark Andreessen and A16Z and a whole bunch of others. They tried to form that committee, and typical of crypto, they disbanded it because nobody could get on. It's like, really, guys, you just had to get on with each other. When are we going to get something a bit clearer?
Yeah, and I think going back to your first point, I think the crypto community is kind of realizing that they might have changed something in a way they didn't fully comprehend. So, the crypto community, the participants have benefited from a regulatory move for the last 4 years. And, if you were Coinbase, you had a war chest and you could say, screw you SEC and fight them off, and your smaller competitors couldn't do that. And, if you were a custodian, Boney didn't want to go into the custodial business because they were told they couldn't, right? If you're a stablecoin provider, JP is not issuing JP coin on Ethereum because they've been told they couldn't. That's all changing. And, you're getting, ICE is pushing for a centralized global crypto exchange. So the idea of it living in all these individual Coinbase and Binance and OKX, et cetera, they're saying that's ridiculous. It should be in one exchange. The big custodians are coming into the custody space. Bank of New York will be custodying crypto, extensively this year. JP will issue JP coin. Like we're getting a lot of stuff. And so, when you talk about our inability to sit and work coordinated, that's going to be a problem as we deal with a different level of competition over the next 6 to 12 months that we had to deal with over the last 4 years. Like 4 years, we had to deal with the regulators, but we didn't have to deal with the banks and the heavily capitalized incumbents coming in and competing with us. And that being said, I think from the regulatory standpoint, Commissioner Pierce is driving the crypto task force. I think that's a great thing for the industry. I don't think they've been super active yet meeting with folks. They released publicly. It's a handful of names. Bo Hines is David Sachs' crypto appointee. I think he's getting his arms around what's going on and looking to lean in. But I know the administration is looking for both market structure legislation and stablecoin legislation no later than the August recess of this year. So, I'd expect you're going to see significant legislation happening over the summer, and hopefully we do it the right way.
And do you think they either collapse the SEC and the CFTC into the same entity, or does this all switch to the CFTC, or do we just get a separate kind of vast regulator and just build it from scratch?
Well, the government certainly indicated that they prefer less than more right now. And so I think the idea of consolidation makes sense. I don't think you're going to see that happen before an August recess. I think that's a much longer discussion. Although, as I said, they want market structure legislation defined by that August recess. So, at least the entities as they exist today, it will be very clear who regulates what by then. And then, I think it's a longer term discussion for them in terms of, does it make sense to have a CFTC and an SEC, for example?
Okay. Mike, ever so interesting. Thank you so much for your time. Good luck for 2025. It's going to be quite a year, I think. You're going to be busy as well. So there's no rest for you, I'm afraid, my friend.
No, there's not. But I appreciate the time today. And thanks for having me on.
Yeah, not at all. Good to see you.
You too.
So look, lots to take away from the video is the complexity of what Mike is trying to do, the magnitude of what needs to get done. These are not simple things that people just think we turn on tokenization and everything works. As Mike explained, there's so many interconnected things and so many people that don't want it to happen. But I think it's interesting. The big one for me was Mike just casually dropping this JP Morgan coin, the JP coin or whatever it's called, as their kind of token and their blockchain to be built on Ethereum. That was something I hadn't really heard. And Mike seemed pretty confident with that. But overall, you can see that this space is going to continue to grow. We can see that the financial system over time will either have to disrupt itself or get disrupted. And finance is the largest use of blockchain of all. So it was set out to do this when blockchain and Bitcoin came. And it's going to continue that relentless journey over time to disrupt and rebuild a parallel financial system. Anyway, I'll see you next time.
Yalla Habibi!
It's good to be here at the main blockchain event of this year.
You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. So we get all of that, all in one place. See you at Token 2049 in Dubai.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.